The escalating trade tensions between the United States and Japan have taken a significant toll on the automotive industry, particularly as American consumers face rising prices for Japanese vehicles. The U.S. government has imposed steep tariffs on auto parts imported from Japan, with a notable 25% tax targeting components critical to the electric vehicle (EV) sector. This policy has directly impacted major Japanese automakers like Toyota, Honda, and Nissan, driving up the cost of their cars in the American market. Once celebrated for their affordability and cutting-edge technology, these brands are now struggling to maintain their competitive edge as prices climb, making them less appealing to cost-conscious buyers. According to a recent report from the Japan Automobile Manufacturers Association, sales of Japanese vehicles in the U.S. dropped by approximately 7% in the first quarter of 2025, signaling a shift in consumer preferences amid these economic pressures. Meanwhile, U.S. automakers such as Ford and General Motors are reaping the benefits of this trade dynamic. Backed by government protectionist policies, these domestic companies have seen a surge in demand as their vehicles remain more competitively priced compared to their Japanese counterparts. The tariff strategy, intended to bolster American manufacturing, has inadvertently handed a market advantage to these firms, drawing in customers who might have otherwise opted for Japanese models. However, this comes at a cost to American consumers, whose purchasing power is diminished by the inflated prices of imported cars. For Japanese automakers, the consequences are even more severe. Declining profits and rising production costs threaten their financial stability. This trade war underscores a broader economic rivalry, with the U.S. leveraging tariffs to protect its industry, while Japan faces mounting challenges in one of its key export markets. As tensions in the U.S.-Japan trade relationship intensify, Japan has shifted from mere rhetoric to decisive financial action, wielding its significant economic leverage to strike back at American policies. Holding over $1.1 trillion in U.S. Treasury bonds, Japan ranks as the second-largest creditor to the United States, a position that has long provided stability to the U.S. economy by financing its debt. However, in a bold move in February 2025, Japan offloaded $30 billion worth of these bonds, a decision that sent ripples through global financial markets. This sell-off weakened the U.S. dollar, as the reduced demand for American debt signaled a potential erosion of confidence in its stability. Concurrently, interest rates in the U.S. rose, a direct consequence of the diminished bond purchases, placing considerable strain on an economy already grappling with inflationary pressures and rising borrowing costs. Japan's strategy is a high-stakes gamble, using its financial clout as a weapon to counter U.S. tariffs on its automotive industry. By divesting from U.S. bonds, Japan not only retaliates against the 25% tariffs on auto parts, but also asserts its ability to influence American economic conditions. The increased interest rates burden U.S. consumers and businesses with higher loan costs, while a softer dollar raises the price of imported goods, further squeezing American purchasing power. This move has heightened financial pressure across the U.S., prompting concerns among policymakers and investors alike. Japan's actions underscore a willingness to escalate the trade conflict into a broader economic showdown, leveraging its status as a major bondholder to challenge U.S. protectionism. As this financial maneuver unfolds, it raises questions about the sustainability of such retaliation and its long-term impact on the fragile balance of global economic power. In response to the mounting trade barriers imposed by the United States, Japan has embarked on a strategic overhaul of its automotive production, shifting operations away from American soil to more favorable regions. The U.S. tariffs, particularly the 25% levy on auto parts crucial for electric vehicles, have made manufacturing within the U.S. increasingly untenable for Japanese automakers like Toyota, Honda, and Nissan. To circumvent these costly restrictions, Japan is redirecting a substantial portion of its production lines to Mexico and Southeast Asia. These regions offer significant advantages: lower labor costs, fewer trade impediments, and proximity to key markets. By relocating, Japanese companies can produce vehicles more efficiently and export them back to the U.S. without facing the steep tax rates that have eroded their profitability. This pivot not only mitigates the financial damage inflicted by U.S. protectionism, but also preserves Japan's ability to supply the American market competitively. Toyota and Honda, for instance, are pouring substantial investments into new manufacturing plants in Mexico and countries like Thailand and Vietnam, where operational costs are a fraction of those in the U.S. This shift allows them to maintain their supply chains while dodging the punitive tariffs that have driven up the prices of their cars stateside. However, the move has broader implications. U.S. workers in the auto sector face potential job losses as production departs, and international investors grow wary of the instability caused by these trade disputes. Japan's relocation strategy highlights its adaptability, ensuring its automotive giants remain global players despite American policies. Yet it also intensifies the economic rivalry, as Japan leverages geographic and economic advantages to outmaneuver the U.S., reshaping the landscape of international manufacturing in the process. As the trade conflict with the United States escalates, Japan is poised to wield its technological prowess as a formidable weapon, threatening to disrupt America's ambitions in the electric vehicle (EV) sector. Should the U.S. persist with its aggressive tariff policies, particularly targeting Japanese EV technologies, Japan has signaled it may retaliate by restricting exports of cutting-edge innovations like solid-state batteries. These batteries, pioneered by industry leaders such as Toyota and Honda, represent a leap forward in EV performance, offering greater energy density, faster charging, and enhanced safety compared to traditional lithium-ion alternatives. Japan's dominance in this field positions it as a critical supplier, and a potential export ban could cripple U.S. automakers striving to ramp up domestic EV production amid a global push for sustainable transportation. The implications of such a move would be profound. American companies, already racing to compete with China and Europe in the EV market, rely on access to advanced technologies to meet ambitious production goals. A halt in solid-state battery exports would delay innovation, increase costs, and undermine the competitiveness of U.S.-made EVs, especially at a time when the government is investing heavily to bolster the industry. Beyond this, Japan could amplify its retaliation by imposing counter-tariffs on U.S. goods, targeting sectors like consumer products, machinery, electronics, and even agriculture. This tit-for-tat escalation would hit American exporters hard, driving up prices for consumers and straining bilateral trade ties. Japan's threat to leverage its technological edge underscores the high stakes of this dispute, signaling that it is prepared to defend its economic interests with measures that could reshape the global EV landscape and leave the U.S. struggling to adapt in a rapidly evolving industry. Amid the intensifying trade standoff with the United States, Japan is actively pursuing a strategy of market diversification to reduce its reliance on the American economy, forging stronger ties with alternative global partners. One key focus is its deepening relationship with the European Union (EU), a move bolstered by existing trade agreements that facilitate smoother access to European markets. These pacts have opened doors for Japanese automakers like Toyota, Honda, and Nissan to expand their presence in the EU, offsetting the losses incurred from U.S. tariffs on auto parts and electric vehicles (EVs). By ramping up production and sales in Europe, Japan not only cushions the blow from declining U.S. demand, but also taps into a region eager for high-quality, sustainable automotive solutions, aligning with the EU's ambitious green initiatives. Beyond market access, this shift fosters collaboration on advanced technologies, particularly in the EV sector, where Japan's expertise complements Europe's push for innovation. The EU serves as both a vital customer base and a strategic ally, helping Japan maintain its competitive edge in a global industry increasingly defined by electrification. Simultaneously, Japan is boosting EV manufacturing in these markets, ensuring its brands remain leaders in the transition to cleaner energy. This diversification reduces Japan's vulnerability to further U.S. tariff hikes, creating a buffer against economic instability. By cultivating these alternative avenues, Japan is not just reacting to American protectionism, but proactively reshaping its trade landscape. The strengthened EU partnership exemplifies a broader effort to build resilience, positioning Japan to thrive regardless of U.S. policies. As this realignment unfolds, it highlights Japan's adaptability and raises questions about the long-term viability of America's influence over its traditional allies in an evolving global economy. The ongoing trade dispute between Japan and the United States is reverberating far beyond their borders, casting a shadow over global financial stability as Japan's actions challenge the dominance of the U.S. dollar. By selling off $30 billion in U.S. Treasury bonds in February 2025, Japan, a major creditor holding over $1.1 trillion in American debt, has triggered a cascade of economic consequences. This move has weakened the dollar, as reduced demand for U.S. bonds signals waning confidence in its value, while simultaneously driving up interest rates in the U.S. The resulting financial pressure threatens to destabilize not just the American economy but the broader international system, where the dollar has long served as the cornerstone currency. Japan's bond sell-off is a calculated response to U.S. tariffs, but its ripple effects could herald a shift in global economic power. For the U.S., the stakes are immense. A declining dollar raises the cost of imports, fueling inflation and eroding consumer purchasing power, while higher interest rates increase borrowing costs for businesses and the government, potentially slowing growth. Globally, investors are growing cautious, reevaluating the safety of U.S. bonds as Japan scales back its holdings. This uncertainty could spark volatility across financial markets, with a domino effect impacting economies reliant on stable U.S. debt markets. The U.S. now faces a critical dilemma: ease tariffs on Japanese goods to preserve financial harmony or double down on protectionism, risking further retaliation and economic turmoil. Japan's gambit amplifies tensions, testing the resilience of the dollar's supremacy and hinting at a possible realignment of global influence. As this standoff unfolds, it underscores the fragility of interconnected markets, leaving the world watching to see whether compromise or confrontation will define the next chapter of this economic saga. The United States is reeling from an unexpected blow as Canada, its long-standing energy partner, abruptly halted oil and gas exports, sending shockwaves through the American economy. For years, Canada has been the U.S. largest supplier of energy, fueling everything from transportation to manufacturing with its vast reserves. However, escalating trade disputes, particularly U.S. tariffs on Canadian goods, have pushed Ottawa to a breaking point. In a stunning reversal, Canada ceased its $13 billion oil export pipeline to the U.S., a decision that has sparked a surge in gas, oil, and electricity prices across American states. This sudden cutoff has left Washington scrambling, with millions of Americans now facing unprecedented disruptions. Higher fuel costs affecting daily commutes, soaring energy bills straining households, and industries like aviation and manufacturing grappling with rising operational expenses. Canada's move is not merely a reaction but a strategic pivot. Frustrated by years of U.S. trade pressures, it has redirected its energy exports to new buyers, signing lucrative long-term contracts with China, India, and Europe. These emerging and established markets, hungry for stable energy sources, have welcomed Canada's shift, which not only diversifies its economic ties but also diminishes its dependence on the U.S. for American states like New York, California, and Michigan. The loss of Canadian hydroelectric power raises the specter of rolling blackouts, especially as winter looms. The economic fallout is stark. Production cuts in energy-intensive sectors threaten jobs, while businesses face profit declines or closures. Canada's realignment reshapes the global energy balance, leaving the U.S. vulnerable in a competitive landscape it once dominated. As prices climb and supplies dwindle, Washington's failure to anticipate this retaliation underscores a miscalculation that could deepen into a full-blown energy crisis. China has launched a forceful counteroffensive against President Trump's latest tariff hikes, targeting the U.S. economy with precision strikes on both agricultural and high-tech sectors. In retaliation, Beijing has imposed steep tariffs on American farm products like soybeans, corn, and poultry, exports that totaled nearly $22 billion in 2024. This move hits hard at the heart of the U.S. Midwest, a region critical to Trump's political base, threatening farmers with financial ruin as their largest market shrinks. Beyond agriculture, the ripple effects promise to disrupt supply chains, inflate consumer prices, and erode the competitiveness of American goods abroad. If China sustains this pressure, the fallout could spiral into widespread economic hardship, challenging businesses and households alike with higher costs and reduced export revenues. Yet, China's strategy extends far beyond the fields, aiming at America's technological and defense capabilities. Beijing is threatening to restrict exports of rare earth elements, vital minerals essential for producing semiconductors, military equipment, and advanced consumer electronics. The U.S., heavily reliant on these materials, faces a dire predicament. Without swift alternatives, production of smartphones, computers, and even military gear could grind to a halt, driving up costs and stalling innovation. This escalation jeopardizes America's standing in the global tech race, potentially ceding ground to rivals like China and Europe. Trump's administration views tariffs as a tool to correct trade imbalances, but China's response amplifies the stakes, risking inflation, supply chain chaos, and job losses. As Beijing tightens its grip on these critical resources, the U.S. must navigate a narrowing path, either find new suppliers at a steep price or brace for a prolonged economic showdown that could reshape its industrial landscape and global influence. Elon Musk, once hailed as a visionary tech titan, is facing a dramatic fall from grace as his deepening involvement in partisan politics erodes his public image and business empire. By 2025, his approval rating has plummeted from a high of plus 24% in 2017 to a stark minus 19%, a collapse driven by polarizing actions like his appearance at the 2025 CPAC conference, where he brandished a chainsaw to symbolize slashing government bureaucracy. His critiques of federal workers and controversial proposals, such as uncovering alleged fraud in small business loans, have alienated broad swaths of the public, particularly Democrats, whose support dropped from plus 35 to minus 91. Even independents have soured on him, shifting from plus 17 to minus 7, leaving only Republicans, plus 51, as a shrinking bastion of support. This political alignment has tarnished the nonpartisan, innovative aura that once defined him, transforming Musk into a divisive figure. The repercussions extend to Tesla, where U.S. sales have faltered, down 5% in 2024 and a further 11% in Q1 2025, while competitors like BYD, Rivian, and Ford gain ground. With just 20% of American EV buyers identifying as Republicans, Musk's partisan stance risks alienating the broader market that once admired his technological foresight. His erratic behavior, including debunked claims like a $50 million condom shipment to Hamas, has fueled further backlash, compounded by Fox News cutting his CPAC speech mid-broadcast. Musk's policy ventures, such as proposing NIH budget cuts opposed by allies like Senator Katie Britt, highlight the tension between his entrepreneurial ambition and political overreach. This unraveling tests the limits of how far a tech leader can stretch into public policy before losing credibility and market share, signaling a potential preview of broader shifts as society reevaluates the role of influential figures like Musk in shaping both innovation and governance.